All right, so review again. Again, communication, I prefer Canvas. I check every day, and please leave a comment if you have comments or questions about the topics presented in class on Canvas so that your peers can see what kind of questions you're asking. But of course, you can always email me, which is fine, but just note that questions that you ask me, I may actually share on Canvas so that other students can benefit from your inquiries. All right. 2 TAs, and of course, I have office hours, but usually nobody comes. But if you want office hours, I usually am in my office on Wednesdays before this class, and happy to talk about anything you have issues with. Okay, and of course, I mentioned there are textbooks. They are optional, so I will assign readings, but I hopefully have condensed the reading into slides, so that's sufficient for you to master the material of this class. So they've served mainly as reference. So if you need additional exercises, I do highly recommend that you go through the problem sets provided in the textbook. All right, so again, repeating again. Main objective, how to price foreign currencies. That is our objective ultimately by the end of the midterm. The midterm. Afterwards, we want to try to link FX returns with the macroeconomy, and that's going to be linked through what's called the current account, right? It's a way, because the current account is a way in which countries track international trade with each other, and we will go over so-called macroeconomic accounting, in which certain goods and services are shipped to another country and what sort of transactions must take place when that occurs. We're also going to talk about the role of central banks in FX returns. How can central banks leverage FX returns or foreign currency prices to benefit the economy? Like if the central bank cares about employment, how can they boost employment with a weaker currency, for example, which is what most developing countries have been utilizing the strategy for the past 2 decades. We'll talk about all of that. Of course, we will also talk about fiscal policy as well. That means when the government decides to intervene during crises, they may try to boost employment and government spending. That may have an impact on currency value as well. So we're going to try to link foreign exchange with the role of central banks as well as the government of a country. And lastly, we're going to talk about risk management topics. Again, options, swaps, forward contracts, all these things, but just in the context of foreign currencies as the underlying asset. All right, and I know many of my past students go on to taking the CFA exam after this class. So for those of you who are interested in taking the CFA, just note that a lot of this material that I'm presenting in class will help you with your CFA exam. I might give you some sample questions during those weekly quizzes, right, in-class extra credit quizzes. That's going to be very similar to the CFA exam questions, just to give you a heads up. All right, I talked about this already, and reiterate again, you must pass both coursework and the final exam to pass the course as written on the university guidelines. Grade cutoffs I will determine at the end of the semester, but I will do my best to try to pass everyone, okay? All right. So every year I get a large amount of students trying to enroll this class without the prerequisites. And I did that I basically let anyone enroll in this class the first time I taught it, and that turned out to be a mistake because a lot of these students just aren't prepared for the material. The material is actually very straightforward if you have the background. And I can give you some examples here. So why is financial management important? Well, we're going to be talking about currency swaps. Currency swaps is just a bilateral agreement in which you're exchanging 2 different types of currencies with another counterparty. So how do you price these cash flow streams? Well, we have to use DCF analysis, right? We need to rely on discounted cash flow analysis to actually price these securities. If you don't have any background on that, you're not going to get it. Secondly, we're going to try to link, again, FX returns with the macroeconomy. And so you have to have some understanding of how we model the macroeconomy, right? How do we do it? Right? We have to, in your macro class, you must have learned the decomposition of GDP, right? Consumption plus investment, blah, blah, blah. if you don't have an understanding of that, actually that's fine, but you have to. It would be very beneficial for you to have some exposure to it. So when I introduce to it, it's not going to be a shock. Okay. But anyways, that's why we need macro in this class. And lastly, the prerequisites for risk and portfolio management is obvious. We're going to talk about those securities. Again, I mentioned before, forward contracts, swaps, options, all those things, but in the context of a foreign exchange. And if you don't have an understanding how to price options or forward contracts, then you're going to have a hard time. Okay? So for those of you who are taking this class without these prerequisites, just know that this is what I expect you to know coming into this class. And it's up to you to let me know if I need to help you fill in the knowledge gap. All right? So as a reminder, because this is an advanced class, we will rely on some calculus to understand comparative statics. It's not a calculus course, so I'm not going to test you on taking derivatives of very difficult functional forms of mathematical expressions. I'm not going to test you on that. But you would have to be able to, however, understand how certain expressions are derived, because in this class we want to understand the sensitivity of certain parameters with relation to some other variable, and that requires taking derivatives with respect to something, a change in something. But if you don't have that background, that's fine. You can get away with doing well in this class by simply memorizing the mathematical identities I give you. All right, so don't worry if you don't understand. I will give you the formulas. You simply memorize them and apply them in your exams. Okay? And of course, I will derive everything explicitly for those of you who have the mathematical background. Okay, just to be as rigorous and transparent as possible. All right, so before I start today's lecture, I want to give you an introduction from myself. My name is Shen-Jay Hsieh. You can just call me Shen-Jay. I'm American-born. I got my PhD at UCLA, and I worked at the Federal Reserve for 3 years before I did my graduate studies. And so this is my 6th time teaching, so I learned a lot from students studying behavior here. So I'm always happy to find ways to improve the course quality to make the learning experience as painless as possible. Okay, and this course is, I think, primarily intuition. So if you get the intuition, then the math is just secondary. All right, it's supposed to help you support the intuition, if anything at all. All right. Okay, so before I, go on with the lecture, any comments, questions on course expectations or the prerequisites, deliverables? All right. Okay, so before I start, the format of this class. We will take a 10-minute break somewhere I think between 1 and 2, okay? Because I probably need to go to the bathroom, you need to go to the bathroom. And that also gives you time to ask me questions if I said something before we take the break, and resolve it before we move on, okay? So that's going to be the format. And I hope, it's been a while since I gave an in-class lecture, so I may be moving too fast or too slow. So if I'm moving too fast, you need to let me know. All right? Okay, so what is international finance? I kind of already gave you a preview of what that is. It's monetary relations between 2 or more countries. So at the end of this course, you will understand how interest rates, inflation rates, and of course, exchange rates are related between the network of countries, okay, global countries. And what we're going to do is we're going to try to build a model that combines the law of one price, like the most fundamental asset pricing model with macroeconomic theory. So we're going to be combining different models, and everything will be very streamlined and hopefully intuitive. Okay, we're going to be plugging different variables into other equations and see the link. The 2 models are actually related through this single variable, which I'll talk about later. So that's where we are headed. And before we kind of dive into pricing foreign currencies, I think everyone in this class should start questioning what currency or money is to start with. Okay, and to do that, it's actually I recommend that you all just take out currencies out of your wallet and just look at the cash you have at your hand. Okay, so let's just read a $100 Hong Kong dollar currency, and to kind of give you an idea how we should start thinking about cash or currency in general. So if we read this dollar bill, this is a $100 bill. It's issued by the Hong Kong and Shanghai Banking Corporation. This institution promises to pay the bearer on demand at its offices here 100 Hong Kong dollars. All right, just based on that sentence, some keywords should actually jump at you, right? First of all is bearer, right? Who is the bearer? Well, anyone holding onto the cash, right? Bearer. Second keyword that should jump at you is promises. So just based on this phrase, it should kind of remind you of a certain security that you've seen in your corporate finance class, hopefully, right? So anything that promises to deliver something is probably a debt-like contract. And so what everyone in this class should start thinking about cash is start thinking about cash as some sort of credit, some sort of debt. And you can actually, intuitively think about this by thinking about a debt and decreasing the time to maturity until it's zero, right? If you think about a debt contract that pays 1 year from now, right, pays some sort of interest rate, and we decrease that maturity to 6 months, right? That's actually a very actively traded security, right? That's called T-bills in the US. I don't know what's called in the UK, but these securities are heavily traded. We can actually continue doing that, decreasing that 6-month maturity all the way down to 1 day. So what's the basic difference between a debt contract and cash? Is 1 day significant? Probably not so much as you think, right? And so we should all starting in this class, to think about cash as some sort of debt contract that does pay some sort of interest. What's the opportunity cost of holding on to cash? Can someone tell me? Yes? Well, that's right, right? That's right. But what institution compensate you for holding on to cash, though? So when I say holding on to cash, I mean you could put it somewhere. Sorry? Yes, exactly. Savings deposits, right? Saving deposit rate. That is the opportunity cost of holding on to cash, right? So cash actually does pay some interest, right? Very marginal interest rates for the past, I guess, 10 years, right? Since 2008, slightly above 0%, but suddenly it's increasing fast. But that is the return holding on to cash. And if we start thinking about cash like debt, then it's quite obvious how cash is related globally, right? It's linked through the relationships between interest rates set by banks. Correct? All right. So to reiterate, cash should be seen as no different than a debt contract issued by the government of your country. Right? Just imagine decreasing the maturity from whatever not positive maturity years to maturity to zero, right? Cash is basically debt. And you can imagine there's practically no difference between cash and a debt that expires 1 day from today. Cash does pay interest. It pays a bank deposit rate, right? Whatever that is. Zero, I don't know what it is now, like 2% now, maybe. Every country's banks pays a different interest rate, right? And so you can imagine we should be able to price currency by kind of thinking about arbitrageurs trying to leverage differences between interest rates across different countries, right? So I'm probably getting a bit too ahead of myself now, but that's where we're ultimately going. As people of finance, we're interested in interest rates, okay? But of course, this is also partly a macro class. We will also attack exchange rates or learn to price foreign currencies from the real side by looking at tangible, real goods and services. So let's do that now, okay? So this is an example. How do we price foreign currencies looking at real goods and services? So in this example, I pulled up a bottle of Coke, okay, from 2 different countries. One from the UK, so this is Tesco. This is, I think, a supermarket chain in the UK. And I pulled this up maybe 2 years ago, and they're selling a bottle of Coke, 1.25 liters, at 1.45 euros. So you probably can't see this, but anyways, that's how much the bottle of Coke is selling at Tesco, okay, in the UK. On the other hand, we also have the same bottle of Coke. See, identical good here, 1.25 liters, right? Both Coke Zero, probably most likely the same formula, I don't know, but let's assume it is. They are, on the other hand, are selling a bottle of Coke for 11.5 Hong Kong dollars. So just based on an asset pricing theorem that you've all learned called the law of one price, you should conclude that these 2 goods, they are identical goods. They should ultimately be cost the same, right, to buy, correct? Otherwise, you could have arbitrage. You can borrow some money, buy low, sell high, right? That's basically how the law of one price operates. And we can actually calculate what the implied exchange rate should be when we try to derive this exchange rate based on the law of one price, right? So let's go ahead and do that. So the law of one price tells us that these 2 goods, after currency conversion, should give us the same value. The bottle of Coke costs 1.45 pounds per unit of Coke Zero. After currency conversion, so let's multiply by the price of pound sterling. I'm going to denote E as the price of pound in terms of Hong Kong dollars. All right? So I hope this is clear, right? This is currency conversion, right? From 1.45 pounds to Hong Kong dollars after I multiply by E. This multiplication, currency conversion, should give us this price per unit of Coke Zero. That's going to be equal to 11.5 Hong Kong dollars per 1 Coke. Correct? Do people disagree? All right, cool. Based on this formula, which is basically the law of one price, which you've all seen in your finance courses, we can solve for the exchange rate. The implied exchange rate, which is simply the ratio, ultimately the ratio between these 2 prices, 11.5 Hong Kong dollars divided by 1.45 pounds, is going to be equal to 7.93. Right? So what have we done so far? So what we've done is try to solve or identify the exchange rate or the price of a foreign currency based on homogeneous uniform good, right? A bottle of Coke is basically the same everywhere, no matter where you go. We're looking at the same size, the same Coke formula, the same taste, whatever. And based on the law of one price for identical assets / goods, commodities, the law of one price must hold, and as a result, we should be able to back out the exchange rate based on these 2 identical goods, right? This good, okay? So the takeaway here is that intuitively, the law of one price should absolutely hold, right? Otherwise, you can make, free money, riskless cash. But the takeaway here from this example is this exchange rate is only serving one type of good, right? It's only serving Coke. This foreign exchange rate has to serve every good. Not only every good, but every asset, right? So let's look at a different asset here. So we're still talking about the real side. We're still talking about commodities, goods, and services being traded. Let's look at a car. So if you look at a Jaguar, okay, this is a Jaguar. This is a car, a British company, I believe. They sell this type of Jaguar for 40,000 pounds, okay, 40,265 pounds. If you were to buy the same car in Hong Kong, it's going to cost you 638,000 Hong Kong dollars. Okay, so let's apply the same law of one price again. Again, the law of one price states that for identical goods. This is the same model. Let's assume this, all the other features and miscellaneous add-ons are the same, okay? For identical goods, this car should cost the same no matter where you go, right? No matter where you buy it. Otherwise, somebody can arbitrage and make free money. Law of one price says arbitrage cannot happen, right? In order for things to be priced fairly. So let's do that. Let's start off with the price of a Jaguar in terms of British pounds. 40,265 pounds per Jaguar. Convert it using the exchange rate. I'm going to denote it again as E per unit of pounds. Sending it equal to the price of a Jaguar in terms of Hong Kong dollars. 638,000 Hong Kong dollars per unit Jaguar. Okay? Law of one price holds, so we can back out the exchange rate. Again, the exchange rate is the price of British pounds in terms of Hong Kong dollars. And that turns out just simply to be the ratio of these two prices, right? And that's going to give us an exchange rate, strangely, of 15.84. All right, so can someone tell me why the exchange rate seems to be so different for two different types of goods, particularly for this example? Any reason is fine. What's some economic reasons why this car, why this, because of the pricing here, why it turns out to be more expensive in Hong Kong than it is for Jaguar? Sorry? Yes, it's possible. So it's possible that this is actually including import costs, right? Transportation costs. If it's not manufactured locally, then that price could be tagged on to the product, right? Not only Jaguars, but you can think about oranges or other commodities. These things have to be factored in. Any other reasons why the prices might be so different? An obvious reason that's set by countries. Did someone say taxes or tariffs? That's right. Okay, so I don't know about Hong Kong, but certainly most countries want to protect their domestic industries. And to do that, they have to set up tariffs. And a lot of times, these tariffs will be passed on to the buyers, right? All right, so there are several reasons why for Jaguars it's particularly expensive to buy in Hong Kong than it is to buy Coke, okay? And it's difficult to reconcile. But in macroeconomics, we tend to think about averages. So one way to reconcile these two very different exchange rates, right, implied exchange rate between two homogeneous goods, is that we just assume that this exchange rate is actually serving a basket of goods, right? And we have to properly weight these goods in order to back out the proper E. Okay? So we'll talk about this later. This is called the purchasing power parity theorem. So we'll talk about that later. But anyways, this is where we are headed. All right? And we're going to start by kind of figuring out how to price foreign currencies from the real side first before we dive into the financial side later. But let's talk about the financial side. All right, so as I said before, other than goods and services, commodities and whatnot, the foreign exchange rate should also be able to serve financial assets as well, right? Stocks, bonds, whatever. And the most fundamental asset, right, that's issued by governments is their debt, right? And they pay interest. And they're the one, these securities are the securities that pay interest rates on deposits, on government-issued bonds, treasuries, gilts, whatever. And these countries, specifically for developed nations, these interest rates paid on these securities are virtually riskless. So if we apply the law of one price on riskless return, then we should also be able to back out the exchange rate, correct? So let me say that again. So far, we looked at backing out exchange rates from looking at real goods and services. Cars, Cokes, you can also use lawyer fees, whatever. These are all things you can think about that's homogeneous, and you can back out an exchange rate. But from the financial side, we can also think about assets, right? We can think about stocks, bonds, and I think the most obvious uniform asset that you can think that you can arbitrage is obviously riskless interest rates, bank deposits on return from different countries, for example, between the UK and the US, right? And if these two interest rates are basically riskless, they're basically the same kind of risk profile, then the law of one price should also apply in this case, right? And if you are an arbitrager, you can try to make risk-free profits, right? How do you do that? Obviously by borrowing low, right, and lending out at the higher interest rate. This is a very fundamental trading strategy called carry trade. Okay, so this is what carry traders do. They borrow low interest rate countries and they try to make high interest rates, but of course they're exposed to a very certain specific kind of risk. Right, that risk is called foreign exchange rate risk. Right, and let me explain to you why it's going to be hard to actually profit off of carry trade. So let's suppose you try to do this. Suppose you borrow at 0%, from the U.S. maybe 5 years ago. Okay, and you try to invest in high interest rates at, I don't know, Brazil, assuming Brazil is not going to default. I know that's a bad example, but very few countries pay 10% on deposit. But let's make that assumption. All right. So if this is actually profitable, then you should actually be making a differential here, right? 10% minus 0% after currency conversion. But that's kind of where things start to fall apart, where your trading starts to fall apart. You have to convert your currencies in order to make this trading strategy possible. So what do? You use the borrowed currency, and then you have to buy a different currency, right? So in this case, you have to buy the Brazilian, I think it's called the real, right? I don't know. And this action of borrowing currency, borrowing a certain currency, and buying another currency is going to put upward pressure on the currency you're going to try to lend out with, right? At 10% with. And because of this act of buying the currency you're trying to lend out in, that's going to actually depreciate the value of the currency you're borrowing, right? Because I'm buying a different currency using the currency I borrowed. And that action itself is going to raise the price of the currency I'm trying to invest in. Yes? So based on this mechanism, you can already see that this carry trade is not a guarantee. You're basically betting that the currency the currency you're borrowing won't depreciate so much to wipe out any interest rate gain you may have. Okay? So I'll repeat that again, but we will talk about this in detail next week. But again, this is just to give you an intuition of where we are headed. We're simply applying the law of one price over and over again so that we can find a meaningful way to back out the price of foreign exchange rates. Okay? We looked at real goods and services. Now we're looking at financial assets, namely government-issued bonds. Government-issued bonds are riskless. They pay risk-free interest, and we can arbitrage these interests if there is a differential, right? We can try to arbitrage if there's an interest rate differential. 10% versus 0%. As an arbitrager, what do you try to do? You borrow low, and you try to lend out or invest at the high interest rate. But in doing so, there is a step you have to make, which is you have to convert your currencies. But in doing so, you're going to actually devalue one of the currencies, and that's going to hurt your returns. Right? That's where the arbitrage breaks down, right? And so if we apply the no arbitrage pricing theorem in this context, in this situation, you have to conclude that currency depreciation, right, or currency returns is going to be determined specifically by interest rate differentials. Okay? That's where we're going to head. Ultimately, all currency returns must be explained by interest rate differentials or expectations about interest rate differentials between the network of countries we're going to look at. All right. Comments, questions? I hope I didn't lose people. But anyways, this is something we will look at in much greater detail next week. This week, we're just focusing on more of the macro, the real side of pricing foreign exchange rates. All right, so how do we start? So our ultimate objective is to link FX rates, foreign exchange rates, to the macroeconomy. How does one model the macroeconomy? So my suggestion is to think about now countries as like individuals trying to buy things from other countries, right? So we're just thinking about a household represents the U.S., a household represents China, and they want to buy things from other country from different households. What's the key determinant of accepting currencies, self-issued currency or credit, right, in order to trade or buy, exchange certain things with a different household? So, put another way, if you want to borrow money to buy a house, what's the most important variable or determinant that a mortgage banker looks at?
Credit history.
Sorry?
Credit history.
Sure, credit history, which is based on
Amount of money you have.
yes, income, all right? So we're going to model the economy with national income, all right? So it's important to kind of make a distinction between what you've seen in your other classes when we're modeling the macroeconomy based on GDP. GDP is not an ideal variable to look at because GDP only looks at income generated by the boundaries defined by the country. So if you have foreigners living and you have foreign enterprises, foreign companies living and operating in the US, for example, that income is counted in the country, despite most of the income is actually moved elsewhere later on. So GDP is not an ideal measure. We want to have a variable that captures income that's going to be spent within the country, used for investments, and so forth, right? Because ultimately, at the end of the day, it's the credit of the citizens or the residents of that country that matter, right? For the creditworthiness of your currency. So maybe I type something here. All right, I'll have a table for you later on. Okay. All right, so where does income come from? It comes from several factors I listed here. We have employment, people making money with jobs, right? We have production, we have companies, institutions creating things, selling it to people, money coming in. And of course, we have growth, right? Expected growth. Investments, right? Investments is future income. Of course, based on income, we're going to be subject to multiples of factors, variables that we're going to be interested in. Business cycles, which is probably mostly captured by interest rates. Fiscal and monetary policy shocks. We kind of want to know what these variables are going to, how it's going to impact income, production, output, and ultimately how that's going to impact foreign exchange rates. Okay, so the key variables we're going to be thinking about are the following: unemployment, consumption, and most importantly, trade and current account balance, which I'll talk about soon, and of course, money, price level, and exchange rates. So price level, we're going to be think about CPI, Consumer Price Index. That's the price level. Money is like M1, M2, like money in circulation. This is the stuff when people talk about printing money. That's what money I'm talking about. All right, and current account. So what is the current account? The current account I'm going to define in two ways, basically. The real side and the financial side. The current account, at this juncture, you should think about simply as a way to measure how much trade is goods and services are coming into a country or leaving the country. So a country with a positive current account balance means that they are producing more than they can consume. And so whatever that's not consumed is obviously going to be exported out. So a country with a positive current account, it means that they are net lenders in terms of goods and services. When a country exports something, that means they're actually accepting something in exchange, right? What are they accepting? Cash, currency, right? So currency, again, is a form of credit. And when you export something, you're accepting credit from another country. And with that credit, that means that the exporting country can use it to buy goods and services in the future, right? So when a country has a positive current account or net export-import that's positive, that means they are a lender, right? They are a lender in terms of real goods and services, as I defined it, but it's also a net lender in a financial sense, which I will tell you in a few slides later. Okay? All right, so I kind of want to hammer in the difference between GDP and net income a little bit more. So let's kind of review why that's important. All right, so income is the most important measure we should be thinking about. As I already explained, income is the key variable that determines how creditworthy you are. It measures your ability to produce things, future growth, and so forth. And so this is the ideal measure to use if we can get it. But in this class, we're not going to be using national income as a variable because, again, very difficult to measure and collect. We're going to be using something a little bit simpler. But it's important to note the difference between GNP and net income, or NI or GNI. All right? So we're going to be using gross national product. Gross national product just means things that are sold at the national level. So if you have a McDonald's, which is a US company that's operating in China, making money, that income that's generated from China counts towards GNP. Okay? But it does not count in GDP. Again, because GDP is defined based on borders, not at the national level. Okay, so national income, again, to review, specifically income earned by residents and domestically owned factories of production. It doesn't matter where these factories are located, as long as they generate money and that money is transported back to their domestic countries, that's going to count towards national income. And the way we keep track of international trade or bilateral exchanges, either for financial assets or for goods and services, for cash, is going to be recorded based on what's called balance of payments accounting. And there's going to be two types of balance of payments accounting. One is, again, the current account. That's an exchange for currency for goods and services. And there's going to be the financial account, which is an exchange of financial assets for currencies, foreign currencies. Okay, so financial assets is like stocks, bonds, and so forth. Comments, questions? Hopefully my definitions haven't lost anyone. So to review again, current account at this juncture you should think about simply as net exports minus imports, right? If you have more exports than imports, that means you are not consuming all that you are producing. And any excess is going to be exported or moved out of the country, right? So in the real sense, a country is lending to another country in terms of goods and services when you have a current account that's positive. On the other hand, if you have a current account that's negative, that means a country is importing more than it's producing, right? And if that's the case, then they are, by definition, right, borrowing using their credit, which is cash, right, their currency. They are borrowing using their currency to buy products, goods and services today so that they can pay them back later in the form of future exports to the country that they've traded with. Right? So money, again, is a form of credit or very, very, very short-term debt. Okay? right, so you must have seen this equation dozens of times in your econ class, right? It's going to be the same. But again, the subtle difference here is we're talking about production and income that's generated at the national level. So again, not defined by the boundaries of a country, but defined based on whether or not income is being generated within the country or by firms abroad that's moving money back to the country, their home country. So Y is going to be defined approximately as net income at the national level, national income, equal to C, which is domestic consumption. Domestic consumption plus investments plus government spending plus net exports, EX minus IM. So you can think of G. So let me go through each variable. Consumption is like money that you make and you spend domestically. That technically is your income, right, in terms of expense, if you measure income in terms of expense. Investments is like buying stocks and bonds within the country, right, domestic investments. Government spending can be thought of, again, as a form of income because it's like taxes, like a tax rebate. So if a government decides to increase government spending, you can think of it like the Hong Kong government giving you consumption vouchers. That's part of your income, right? All right, this is the link between countries, right? And ultimately, the link that's going to determine exchange rates as well between countries. If EX minus IM is positive, right, that means you are lending whatever you produce abroad, right? You're producing a lot. But if this part is positive, that means part of your production is being shipped abroad. So in that sense, you are a net lender in real goods and services. Again, if EX minus IM is negative, that means a lot of your consumption, part of your consumption, is determined based on willingness from other countries to lend you credit, right? So that you can consume today and pay back later. All right. So this is like the nitty-gritty details, not intuitive at all. It's not easy to explain, but for those of you who want the nitty-gritty details, here's the difference between GDP and GNP, okay? So GNP is defined actually as GDP plus net transfers. What's net transfers? Well, they include domestic factor income abroad, less foreign factor income at home. So if there's money being made by foreigners and that's moved to other countries, back to their home countries, that's being netted out. Okay. If there's people like me that pay U.S. taxes, okay, I make money here. That income is counted in GNP. All right. And we're using GNP because it's more closely related to national income. But of course, national income is the ideal measure to use, but it's hard to break it down into these components that we see here. Okay. But anyways, if you want to know the relationship between GNP and national income, you have to make the following adjustments. Depreciation means some of your assets are less valuable than before. You have to subtract it. Okay. Unilateral transfers. So remember, balance of payments track bilateral transactions between countries. That means you have to have a counterparty. But sometimes transactions only go one way. And that's when you have like domestic helpers in Hong Kong sending money back for remittances. That's a unilateral transfer. You have people on vacation traveling to your country and spending money. That's a unilateral transfer. Okay, you have to net this out as well. And tax wedge and prices. So that's like the difference between what buyers pay and what sellers sell it at. Okay, so that's like so you can think about it as tariffs. These things are not counted in GNP, right? Because that's collected by the government. But of course, that should actually be also adjusted to arrive at net income. Okay, so to summarize, again, GDP is calculating approximately expenditure or income by the boundaries of the country. So if you have countries, tax havens like Ireland, for example, in which you have lots of companies parking their money there, you can imagine their GDP is massive compared to the net income. I think it's like 20% over net income. GDP, on the other hand, only looks at income generated by residents and also enterprises, residents and also residences and enterprises operating abroad. Okay, it's not a perfect measure of income, but it's good enough for our analysis here. Okay. Comments, questions on the definition of GDP, GNP, and net income, national income. All right. So I may be overdoing it, but let's go through an example here. So we call this the Robinson Crusoe example because, like the novel, we want to think about a closed economy that wants to open itself to international trade. Okay, so just imagine we have one native on a specific island, and it's going to borrow some money from elsewhere, from another island, and it's going to increase it's going to produce something, and we want to kind of figure out what its GDP is and what its GNP is. So let's look at an example in which we have one native that there's one type of production. Okay, it's going to be coconuts. Coconuts can be either consumed today, or you can actually carry it forward by planting it in the ground and allowing it to grow into another palm tree, in which you can collect another coconut. All right, so one palm tree produces one coconut, then dies. Coconut. All right. So you can either consume. You can either consume the coconut, or save for next year, right? By planting it and letting it grow. So suppose you have one native that harvests 100 coconuts and borrows 10 from a neighbor. So I want you to tell me what the GNP is, GDP and GNP is, after 1 year. Okay? Can somebody tell me the answer? So let me reiterate. You have one means of production. You can grow you have coconuts. You can plant it and let it grow into a palm tree that produces another coconut, and you can harvest it. You have a choice of either consuming it today or saving it for next year by planting it back into the ground. Suppose you have one native that harvests 100 coconuts and borrows 10 from a neighbor. And he plants this native, plants all, and gets 110 coconuts at the end of the year. What is the GDP and GNP in this setting in terms of coconuts? Close. So 110 should be clear, right? Because based on the boundary of the island, right, that this one native lives on, he harvests 100 coconuts plus 10, and he plants it all. And the following year, he produces 110 coconuts. Just based on production, an output of 110. And if you define output by boundary, then GDP should be 110 coconuts. For GNP, you can think of this 10 coconut as a loan from abroad, okay, that you have to pay back. in that sense, then GNP needs to exclude the 10 you need to pay back, right? So assuming you pay back 10, it should be 100 coconuts. So in this setting, you can clearly see that GDP most likely will exceed GNP. And the example I typically give is Ireland, in which its GDP is 20% higher than its national income. So we focus on GNP to exclude these scenarios, right? We want to ultimately, again, think about countries' creditworthiness, which is based on those that live and spend money within the country. So if we want to analyze Ireland, we should not use GDP. We should use some measure closer to national income, and GNP is, I think, a reasonable measure, at least for this class. All right, so I hope that's clear, the differences. Okay, so our next task is to kind of understand what the current account is. I kind of already spoke a little bit about this. Current account, as far as you should know, is simply a way to track trade volume, right? Exports minus imports. And I try to give you some intuition, but for those who need math, here's the math. Okay, so net exports, or the current account, should be defined as anything that you produce but you don't consume domestically, right? If you don't consume domestically, then someone else abroad is going to buy it from you or consume it for you, right? And you can exchange those consumptions for credit, or in other words, their currency. So let's write out the math. Y. Y is a measure of domestic output. Y minus consumption, investments, and government spending. So these are all expenses, right? Domestic expenses. We subtract total output from expenses. Whatever is left over is going to be outsourced, right? Shipped abroad, lent out. And that's going to be equal. That's obviously, right, based on the definition of GNP, right, should give you EX minus IM, right? I is C plus I plus G plus EX minus IM. Subtract the domestic expense part. It should give you net exports. That is how you should see the current account now. Okay, I will show you the financial side, of course, but this hopefully is the more intuitive way to look at it for now. So the example I give you here, I'm going to hammer it again into you, the idea of how to interpret the current account as a way of measuring loans and lending and borrowing, right? Either in terms of financial securities, or in terms of goods and services. A positive current account means that Hong Kong residents must give up domestic consumption or investments for exports, right? You can have exports, but you just can't consume what you produce, right? That's what this equation is saying, right? If you produce more than you consume, then you can lend it out, right? You can export it. So what do they gain? As I mentioned over and over again, they gain foreign currency. They gain the promise of foreign debtors to pay back in the future, either in terms of income, in terms of profits, right, corporate profits, or in terms of goods and services. They are the same thing, okay? It means the same thing. Domestic residents receive foreign assets for net exports. That asset, their currency, their credit. All right. So if you look at the textbook, there is actually a component of the current account that I'm not mentioning here. So the current account should also capture net transfers from investments abroad. So I kind of excluded it here or hide it here because I think it may be confusion. But you can obviously see this later in a few slides that the current account is actually also is measuring profits that you get from investments abroad. Okay, so just wait on that. But that's just something to pay attention if you check the textbook. Okay. All right, so let me give you an idea of what GNP looks like and its components. So this is very old data, but more or less looks the same, maybe more exaggerated a little bit. So this is the U.S. gross national product decomposed into its components. It's consumption, government spending, current account, and investments. So the takeaway here is that for developed nations like the U.S., Canada, the U.K., consumption is the biggest part of their national income, right? If you measure, GNP. So if you think about consumption as expense as part of their income, yes, most of it is just spent domestically on goods and services, all right? What you should note is that for developed countries, this part, or the current account, is most often negative. So remember, current account, as far as you can tell, should be a measure of trade volume, trade flows. So a negative trade flow indicates that this country are net borrowers in terms of goods and services, right? They can do this because their credit worthiness is great, right? Everyone loves U.S. treasuries. Everyone loves British gilts. And they can issue debt without much worry that their credit worthiness will be downgraded, right? By the S&P or Moody's or whatever, okay? They can do this, all right? So maybe I'll write a note here. This is the takeaway here, right? So current account is negative, which means net borrowers. Okay. Oh. This one. All right, next slide. All right, so this is taking each component of the GNP and now scaling by GDP. The takeaway from this graph is this part, right? And also this part. So both for, again, developed nations, they can obviously consume and spend beyond what they make because they have good credit. And you can see that these consumption beyond what they produce is explained by how much they can borrow abroad, right? So again, this part is borrowed consumption, borrowed spending, okay? And this is current account less than zero, right? Or borrowing on credit. Okay, so this is for US and maybe Canada, UK, but what about Asian countries? Well, Hong Kong has a positive current account. Of course, it looks very similar. It has, consumption mostly explained, the bulk of their GNP, but this part is not negative. The current account is in fact positive. China, on the other hand, I don't know. It may have turned over the last 3 years, but before the pandemic, they had a positive current account, which means that they're net exporters as opposed to net importers. All right, so let's go through how we track transactions on the current account. That's what balance of payments means, okay? So remember, balance of payments means bilateral transactions between countries. Every transaction has an opposing transaction because when you buy something, you have to give something up, right? When you go to the store, you buy bread, you have to pay with currency. Same thing here. When a country goes and imports something, they have to give their currency to the other country. That's going to be tracked by the current account. And I'll go through some examples. I'll go through one example, okay? Financial account. It's everything else. So if you're not buying goods and services, but you're buying stocks, bonds from startups or companies abroad, if you buy like a mutual fund that tracks the Chinese companies, this is going to be tracked by financial account. Anything that occurs purely on the financial account is not going to show up on the current account. Okay? So financial transactions it's not going to change the current account. All right, as I already said it, bilateral transactions, so double entry bookkeeping. Commodity flows are accompanied by reverse financial flows, right? You have to pay goods and services with cash in return for receiving imports. And financial transactions involve creditors and debtors. Okay, so what this means is that for the current account, if you're going to buy something, an import is going to look like a debit, like in a checking account, okay? When you export something, it's going to look like a credit. Plus, all right? I think I hammered this in very early on, right? When you export something, you're receiving somebody's credit. So that's why it's positive if you're exporting, and it's minus if it's importing. For financial transactions, it's just like a checking account, right? If you spend, it's going to be a minus. If you receive something, it's going to be plus. So let's go through some examples. So for the current account, a transaction. So this is a transaction in which, on the whole, the U.S. is exporting movies to Japan. So think about intellectual property, licensing fees, and all that stuff that's bundled with exporting movies. So what's being exported? What good and service is being exported? Film, okay, IP. And it's going to be exported to Japan. Japan, their companies are going to pay for these films with their credit, with cash. So at the exchange, they're going to deposit their yen, Japanese yen, and the U.S. is going to be receiving Japanese yen and giving up those IP rights or whatever movies to Japan. So let's see what happens. So if the U.S. exports movies or service export, as I said, any sort of export should look like a credit. So on the current account, that's going to be a positive. So let's assume that credit is going to be let's say $10 million. And when you import an asset, it's going to be a minus. Okay? So you're importing yen. That's going to look like, that's going to appear at the current exchange rate before you convert it to US dollars. It's up to the seller to convert the currency. And that's going to look like a debit on the financial account. So remember, when you buy something and you receive credit, it's going to be import of an asset. It's going to be a minus. On the other hand, when you're exporting something, it's going to look like it's going to be a positive, plus. Okay, so that's a commodity, right? A good or service. All right. Next one is a purchase of government bonds. So what they're going to do, this is a purely financial transaction. So anything that goes on here is not going to have an immediate impact on the current account. Okay, I say immediate because, remember, the current account actually has a net transfer component that I kind of omitted on purpose. So this transaction itself will not have an impact on the current account immediately. But if those investments pay profits or dividends, those dividends will count in the current account. But anyways, those are minor details to know. Okay, anyways, for Japanese government bonds, if the U.S. writes a check to a Japanese bank, right, they're going to send out some U.S. dollars. There's an export of U.S. Currency. So it's a credit to the financial account of $10 million. At the same time, they're going to receive bond acquisition. So they're going to be importing assets. Again, bond is kind of like credit, like literally credit. That's going to appear as a debit on the financial account as minus $10 million. So this table here is not, again, because it's only dealing with financial accounts, financial assets, it's not going to have an impact on the current account. So it won't impact exports and imports immediately. But if this investment pays dividends or interests, this will count towards the current account. But for now, don't worry about it, okay? This transaction will have an immediate impact on the current account because there is a credit that occurs here when there's an export of a commodity, right? So so if a country had a current account of 0 and this transaction occurs, you will note that the current account will then be positive, right? Because they are exporting a commodity or goods or service, and as a result, they are a net lender or net exporter, right? They're a net foreign lender because they're receiving foreign currency in exchange for, and then shipping out or exporting their goods or services. For this transaction, nothing will occur, right? The current account stays the same because the only thing that happens is the change in the financial accounts. But if this transaction, if this asset pays interest or dividends, that will count as profit and as a result will impact the current account in the future. But in the immediate, at time 0, this will have no impact on the current account. So here, I'll write increases CA. And here I'll write no immediate change in CA, but if pays dividends will increase CA. All right. Comments, questions on these macroeconomic accounting? Yeah. Sorry?
So, like, I think I got a little twisted thing in accounting, which is credit.
Oh, yes, yes, yes.
Like, it's always going to be the standard for our calculation. Credit means positive.
Okay. This has no relation with accounting, Stan. Okay, so just keep it segmented, the knowledge segmented. This is completely different. Okay, so just from an economics perspective, just as practitioners in finance, all you need to know is that whenever we're exporting a commodity, it's going to show up as a positive on the current account. Imports will be a negative. Just memorize it. Nothing that has no relation with real accounting. Okay, so this is accounting is in quotes here. For financials, if we're exporting our credit, it's going to show up as a positive on our financial account. So just memorize that. Exporting our currency, it's going to be a positive. If we're receiving something, receiving financial assets, it's going to be a minus, okay, on the financial account. So I'll write it here. So for current account, export is positive, import negative. For financial account, export of credit, it's going to be a positive, and import minus. So credit can be assets as well. I'll show you. It'll be in the next slide. All right, so another example. So here we're talking about foreign investments. So think about an investment in Californian biotech companies. You're SoftBank and you want to buy some startup companies' shares in the new vaccine or whatever. This is what a transaction will look like on the financial account. So SoftBank wants to buy shares, so there's going to be it's going to be an export of their currency, right? So it's going to look like a credit on 10 million on their financial account. But at the same time, they're going to be importing U.S. shares, right? Sorry, this is the perspective of the U.S. Sorry, I got it backwards. So we're the U.S. still, okay? Japanese share purchase, they're going to be buying our shares. So we are exporting financial assets, namely private shares, and it's going to be a credit, right? Because we're exporting our assets. From the U.S. perspective, we are receiving their credit, which is Japanese yen, and that's going to show up as a debit on our financial account. So I'll make that clear. From perspective of U.S. Okay. I think this is also from the U.S. All right. So hopefully that's clear. So I apologize for that confusion. So of course the transactions are the opposite, the mirror image, if you're Japan. From the perspective of, so again, from the perspective of the U.S., we are exporting assets. We're exporting private shares of a startup to a Japanese bank, such as SoftBank. That's an asset export. Any export of domestic assets is going to show up as a credit. But at the same time, we're importing credit, foreign currency, and that's going to show up as a debit on our financial account. So this transaction, again, the immediate transaction is not going to have an impact on the current account. Because the only thing that's changing in the balance of payments is the financial account. No immediate change in. Okay. However, if these private shares were to pay dividends, right, then that's further export. That's an additional export of income, right? So that can change the current account. But anyways, this transaction itself has no impact because only financial account is being involved here. For this last table here, again, notice that there is a debit occurrence in the current account here, so there will have a decrease in the current account. Okay, so let's walk through it. In this case, we are importing equipment from abroad, again, from the perspective of the U.S. So there's going to be a debit on the current account. We are importing, we must subtract. At the same time, we're exporting dollars, so that's going to show up as a credit on the financial account. So if we had a balanced current account where the current account is around 0, and we imported lab equipment, our current account will then turn negative, right? And therefore, the U.S. will be deemed as a net importer of net or a net foreign borrower, right? Because we're exporting our U.S. dollars, that means we have to pay the foreign country back somehow in the future, right? Either in terms of future consumption or payments of returns on assets, right? Something like that. Okay. All right, comments, questions? Yes?
Do the countries' financial accounting, current account always balance each other?
Yes. So these are double entry book accounting stuff. So there has to be, these have to cancel out. Yeah, they have to net out. So these are all bilateral transactions. Balance of payments are only concerned with bilateral transactions. That means between countries, there has to be an exchange of something. Okay. As mentioned before, unilateral transfers are not tracked by GNP, right? So in this scenario, we're only concerned in this setting. when constructing our model of exchange rate, we're only be going to concern with these bilateral transactions. Okay, international trade is all bilateral. All right. Comments, further comments, questions? Oh. All right, so I may have to move a little bit faster, but anyways. Savings, okay, so the other side of the current account, the other way to view the current account is from the financial side. As I mentioned earlier, right, we can think of the current account as lending money to other countries in the form of future, returns, right? It doesn't have to be in terms of consumption. It could actually be in terms of returns, financial returns. And we can actually derive this idea that the current account captures savings abroad by showing you in a few seconds that in an open economy, total savings is investments domestically and investments abroad, right? It depends if the CA is positive or negative, right? If CA, the current account, is positive, that means part of our savings is abroad. So if you make investments in other countries and it generates returns, that's going to be captured by current account. And I will show you that mathematically in a slide, in the next slide. So again, in a closed economy in which there's no international trade whatsoever, I think it's clear that total savings of a country must be equal to total domestic investments. That should be obvious. But when you open up, savings has two components. Savings domestically, investments domestically, or savings that's abroad. You can have a bank account in the UK, generates interest. That's going to be captured by the current account here. Okay? So let's derive this very quickly here. Okay? Okay. Yes, so I think I already said everything here. So we ultimately want to show you that this is true. Okay? So if we have this, if we have savings equals domestic savings plus domestic savings and savings abroad, then we can calculate the current account as S minus I. This should be also obvious, right? The current account is simply savings abroad. And we want to show that savings abroad must be equal to net exports. All right, so let's prove that very quickly. So we want to show that S equals I plus CA, right? So let's define savings in two parts. I'm going to write S superscript P, so that exponent sign is superscript, equals to Y minus T minus C. I think this should be clear. Let me explain it to you. Again, Y is total output of a country minus taxes. So P stands for private savings, okay? Minus taxes paid minus consumption, right? So all the money, that's all the goods and services that's produced and sold, that's your income, right? Minus the taxes you have to pay minus consumption, your expenses. So whatever's left over is private savings. All right, so that's part of savings. What about government savings? Government savings is taxes minus G, right? Why is that true? Well, taxes is like revenue collected by the government. Anything that's not spent is going to be captured by this difference, right? Government spending. So that's government savings, private savings. Total savings is going to be SP plus SG equals to Y minus C minus G equals to C plus I plus G plus EX minus IM minus C minus G. And you will get the following conclusion. Right? So all I did here is plugged in these two expressions into SP and SG, and then plugged Y for the identity, C plus I plus G plus EX minus IM. Things cancel out. All I'm left is domestic investments plus EX minus IM. And we all know what EX minus IM is. It's I plus the current account. All right. So if you didn't follow, that's fine. This is the answer. Okay, this is the proof again. The same thing as I just wrote before. Okay, so hopefully at the end of this slide, you can see that the current account has two faces, right? But it's the same thing. The current account can be thought of as, again, trade volume, right? Net exports, total exports minus imports. If you're exporting, you are lending other countries goods and services, and you're accepting their credit so that you can buy their goods and services in the future. So in that sense, you are a net lender, right? Net lender in terms of real goods and services. If the current account defined this way is negative, that means you're borrowing money using your currency. You're borrowing consumption today using your currency, but you have to pay them back in terms of trade in the future, right? From the savings perspective, it's basically the same thing, but not in terms of goods and services, but in terms of investment returns. So if you have a positive current account, that means you promise to, that means you are lending money. You're a net lender of credit to other countries, right? So like China, you're a net exporter. You're accepting lots of currencies. That's why they have large currency reserves, because they're a net exporter. And as a result, they are a net lender in that sense. Okay? And the opposite is true when you have a negative current account. Okay? You're a net borrower on the other hand. Okay, so let's take a 10-minute break for questions. And also, if you need a bathroom break. So we'll reconvene in around 10 minutes. So before moving on to like a history lesson about the international monetary systems over time, I want to give you a third interpretation of the current account. So this is more of understanding the dynamics of the current account in response to policy shocks. So it's not so much a redefinition here. I'm just trying to introduce you conceptual ideas of why the current account could respond positively or negatively given changes in certain variables. Because at the end of the day, we want to understand as policy analysts how changes in certain macro variables, such as prices, exchange rates, can impact trade flows, right? That's kind of what our objective, one of the key objectives we want to accomplish here. So I want to give you this definition. You can think about the current account, roughly speaking, as equal to trade volume, as I wrote on top here, annotated on top, plus relative value of goods and services. All right, so in order to show you this definition with the existing math, I need to introduce to you a new variable. Okay, I'm going to define this variable q, lowercase q, equal to EP star divided by p. So let me tell you what EP star and p means. So p star indicates foreign price levels. So think about it as the CPI of a foreign country. So in this case, if I define the exchange rate as Hong Kong dollar per one US dollar, Hong Kong dollar being the domestic currency and the US dollar being the foreign currency, P star would therefore be US CPI, Consumer Price Index. P, on the other hand, is therefore the CPI of Hong Kong. All right, so Q has a special name. It is called the real exchange rate. And it's supposed to capture the relative price levels between country and also the propensity to substitute away from expensive goods for cheaper goods. So let me explain why that's the case. So imagine we have a sudden increase in Q. What does that indicate? Let's suppose that Q increases because foreign prices are increasing. So if we have a higher Q, price levels after currency conversion, which is EP star, is increasing. So that means foreign goods and services, because it's P star, in other words, US goods and services, are becoming more expensive. And so what do people do when things become more expensive? They substitute away, right, for other goods and services. So when we have Q increasing, the propensity to export for the domestic country is increasing. Yes? That's the intuition that you should all have, right? Hopefully. So given this definition, CA equals EX minus IM, you can imagine that exports can be a function of this relative price ratio, right? EX function of Q. So if Q increases, again, let me repeat myself. When Q increases, that means foreign goods and services are relatively more expensive. Over time, consumers realize that US goods, for example, are more expensive, and they will substitute away from expensive goods and services for cheaper goods and services, assuming consumption baskets between US and Hong Kong are the same. All right, so given that increase in the price ratio, there will be curtailment in imports from the US, and there should be increasing imports from Hong Kong, right? So we can imagine when Q increases, when foreign goods and services become more expensive, Hong Kong will benefit from increasing its exports, right? All right, so I think that's obvious, given that export variable. Now, to see the relative value, so that's the trade volume effect, OK? So that's what I just described, the incentive to import and export. Now, the second part, the value part, that requires us to redefine imports in terms of Q. So to do that, let's think about what imports are. Imports are goods and services we buy from abroad, but alternatively, you can think about as exports of other countries, right? So we can reformulate IM equal to Q times EX star. So EX star is foreign. You can think of it as aggregating all foreign exports together, or just in a two-country case, EX star is just your trading partner, right? EX star. We have to convert EX star to domestic currency, so we just multiply by Q, relative price ratio. And therefore, you can see that IM should more or less be equal to Q times EX star. When you hold trade volume constant, so let's hold EX star and EX constant. When you increase Q, Q will have actually a negative effect on CA because of this minus sign, right? So there are competing effects here, right? One effect from increasing Q that impacts trade volume, right? The substitution effect as people move away from more expensive goods for cheaper goods. But there is also an asset value effect as well, right? When P star increases, it could indicate that asset prices in the US are actually increasing. So that will actually hurt the current account for Hong Kong. Yes? That's kind of the intuition. Of course, to formally derive these sensitivities, these changes in Q with respect to CA, we need some calculus, which I'll introduce later. Okay? But the idea here is to understand how CA should respond to changes in these very notable macro variables, the exchange rate, price levels, right? Those are the variables that create the incentives to export and import from certain countries. Yes? OK, so I just want you to keep that in the back of your head. Of course, we'll revisit later. But it should be part of the two other definitions I gave you already, right? All right, so the last part of today, I want to kind of give you a very quick summary of the international monetary systems that have existed in the modern era, essentially. Okay, why has there been several changes in regimes? Well, there are competing interests. Obviously, satisfying one interest will crowd out other interests, and there's also conflict of interest between countries, as every country may want to be, for example, exporters. If everyone wants to be an exporter, there must be some entity that absorbs the exports, right? Obviously. So there are external balances that I use the term external balance, meaning that, again, for example, you want to be an export-driven economy. That's going to have effects that impact other people. You're externalizing something not automatically onto somebody else. All right? All right. Internal balance. think about the trade-off between growth and price stability. Right? Under the gold standard, which I'll talk about next few slides, the gold standard, we have very, very stable prices. Why? Because exchange rates were fixed. So the gold standard is a very simple idea. Every country chooses the conversion rate between their currency with some quantity of gold. As long as those conversion rates stay the same, there should be implicit exchange rates for any combination of currencies. Right? As long as those conversion rates are the same and stay the same, you should have stable prices to convert one currency to the other. But the drawback of having such stable prices is that international trade can only grow as much as gold that's being circulated. Right? You have to mine for gold. You can't even participate in the system if you don't have any gold. Right? In order to buy goods and services, you need gold to bring to other countries, convert to other currencies, and buy the goods and services. So there are implicit trade-offs, right? Depending on which macro policy you want to pursue. If you want growth, obviously gold standard is not the way to go. If you want price stability, consider some backing of your currency to something else. External balance obviously has to do with the current account objectives of every country. Every country has different objectives. They may choose current account equal to 0. They may choose current account that's negative. They may choose current account that's positive. But at the end of the day, depending on which current account target they have, that's going to have an impact on everybody else, right? So these are conflicting objectives that will hurt others and benefit other people. That will hurt others and benefit some, right? Depending on how the system we choose to institutionalize. All right, so depending on the system, there are so-called rules of the games that people must follow. So gold standard, I kind of already described the rules to you, right? Every country chooses a conversion rate between some quantity of gold for some amount of a currency. As long as those conversion rates stay the same for every country, there are implicit exchange rate ratios, right? Those are fixed as well. If those are the game, then monetary policy is very straightforward. Every central bank's objective is simply to ensure that anybody willing to conduct international trade just bring their gold and convert infinite amounts of gold to their domestic currency so that they can buy goods and services. That's the only point of central banks. By doing this, many drawbacks, which I'll talk about later, but in any case, depending on the system, there are rules that has to be followed. And if people break the rules, then things start to go bad. Okay, you have countries defaulting, not being able to participate in international trade, and so forth. Yes. Okay, so hopefully I conveyed the idea that there are conflicts between countries because of this current account targeting, and different systems offer different pros and cons. So let's talk about the gold standard. Okay, so the gold standard is very, I think, straightforward. Every country, so let me give you an example. I think the best way to explain this is through an example. So let's suppose we only have one good. Let's call it apples. Okay, and let's say the price of an apple costs 10 Hong Kong dollars. And let's assume that Hong Kong decides to peg its currency to gold at this rate. And therefore, the price of apple in terms of gold is the following: 1 ounce of gold divided by 1 apple. Agree? Right? So price of apple, 10 Hong Kong dollars. The unit Hong Kong dollar cancels out, so ounce of gold is in the numerator. Denominator is 1 apple. So that's the price of an apple. given the conversion rate that Hong Kong sets by its currency board / let's assume it has a central bank. Okay. So to reiterate, gold standard. You cannot change. You're not supposed to change the conversion rate. You're supposed to keep it constant indefinitely. All right. That's the rule of the game. So this variable cannot be adjusted. Sorry, this component is fixed. Cannot be adjusted. All right, let's see what happens to prices when we have international trade going on in this setting. So suppose we have people wanting to buy apples from Hong Kong, right? So how do you do that under the gold standard? You have to move gold from your country, domestic country, to Hong Kong, convert gold to Hong Kong dollars, use those Hong Kong dollars to buy apples, then ship the apples back to your home country. That is how international trade is done under the gold standard. All right? So let me repeat that again. To conduct international trade, when you want to import certain things, you have to export gold. All right? You have to export gold to Hong Kong in this setting, convert Hong Kong gold to Hong Kong dollars at the conversion ratio of 1 ounce per 10 Hong Kong dollars, use the Hong Kong dollars to buy apples, and ship the apples back afterwards. This transaction has side effects on prices. As I will show you, when you import gold from the Hong Kong perspective, you will create inflation. And we can see this from this simple equation here. So when you import gold, what's going to happen? Can someone tell me in terms of prices for apple in this case? So if you have more gold, but you keep the supply of apples the same, no more apples being produced, what's going to happen to the price of apples in terms of gold? Increase, right? Why? Because more gold is chasing for the same amount of goods. So the price of apples in terms of gold is going to increase when you import gold. Because we can't change this exchange rate, what's going to happen as a result of nominal prices or fiat prices? Yes, it will also go up. This must happen because we cannot deviate away from the set conversion rate under the gold standard. So as a result of imports of gold, you will naturally have inflation consequently. Okay? Right? The main reason is because we cannot change this variable here. More gold means more gold chasing the same amount of goods and services. And if inflationary pressures can't appear through the exchange rate, it must appear in terms of domestic currency, right? In this case, Hong Kong dollars. So what happens when we have the opposite? Suppose Hong Kong wants to buy goods and services elsewhere. There's an export of gold. What's going to happen? Fewer gold chasing the same amount of goods, so yes, you have deflation. Very good. So this is the key mechanism that maintains the gold standard system, right? Assuming that everyone chooses the convertibility ratio for gold at some level that meets their current account target. Okay? All right. So gold standard is, again, as I already said, very, very straightforward, assuming all countries participate and agree to the rules of the game, which is to maintain convertibility of infinite amounts of gold to their domestic currency and vice versa. All right. Then the central bank's task is quite straightforward, right? Just make sure they keep those. It doesn't depeg, right? It doesn't change its conversion ratio. In that sense, anybody can participate in international trade so long as you have gold. And you have very, very stable foreign exchange rates, right? Because if every country fixes their exchange rates with gold, then there's a natural exchange rate that occurs across all currencies. So maybe I want to show you an example here just to make sure everyone sees that. So suppose you have 1 ounce of gold per X US dollar as the conversion. And also you have 1 ounce per Y, pound sterling. Then it should be easy to see that the price per pound should be X over Y, right? Simply the ratio. So this is deterministic. It is fixed under the gold standard. Of course, there are drawbacks to this system, as I mentioned earlier, right? While you have price stability, your international trade can only grow as fast as your gold supply. That's one. The other trade-off is that countries no longer have the ability to conduct monetary policy. You can't stimulate growth by cutting interest rates because doing so will depeg your currency from the exchange rate. Yes? So if you participate in the gold standard, you have no monetary policy. Your only task as a central banker is to ensure that anybody who brings gold to your front door, you can convert it. Anybody who brings domestic currency, you will allow them to redeem gold at infinite amounts. By these rules, you can already see that there are some problems, right? For those who have lots of gold, they can continue conducting international trade indefinitely. But if you don't have any gold, you may have, a redemption problem, right? You don't have enough gold to redeem your currency. All right, let's talk about how this system is maintained. Suppose all the participants have enough gold to conduct international trade. Let's not talk about gold redemption problems here. So this system is maintained by a mechanism called the price specie flow mechanism. And this is all driven by this relative price ratio Q that we talked about earlier, right? As you import gold, right, it causes inflation. Inflation distorts Q, right, in such a way that certain countries' goods and services appear more expensive. If that's the case, then people will curtail imports of those goods from the higher prices and therefore import from the relatively cheaper countries as a result. And this effect will reverse gold export/import. Yes? So I'll outline the steps again. Or actually, it's outlined in the next slide. So let me read this to you. Maybe that's easier. Okay? So suppose you have a country that has a current account surplus. So that just means that perhaps there's a technology shock. You have new products that everybody wants, and there's a sudden demand for domestic goods and services. So there is going to be an incoming flow of gold soon, and there's going to be inflation. This raises the price of all other commodities in the home country relative to gold. You can see this, right, from the previous equation, right? If you can't change the exchange rate, then if there's an import of gold, domestic prices must rise. If domestic prices rise, that's going to impact Q, right? Q means that your domestic price levels are more expensive than foreign prices. So people will move away from importing your goods and services for the relatively cheaper goods and services elsewhere. So specifically, the domestic citizens will likely move away from consuming goods and services domestically and import elsewhere. Import requires export of gold, and so that import and export of gold will cancel out. That's the mechanism at play here that maintains this CA star, this current account equilibrium target, right, which is based on the conversion ratio that they selected. Okay, so let me say that again. Under the gold standard, every country has probably a current account target they have in mind. Okay, they will set the exchange rate between their domestic currency and gold at some level that satisfies that target level. Okay, in equilibrium, everybody is happy. what this example is giving you is, suppose there is a deviation from that equilibrium. Suppose there is a sudden technology shock, for example, I gave you, that there is a sudden influx of gold that's going to come in. In this case, in which there's an influx of gold that's coming in, that's going to raise domestic prices. Based on Q, right? Q is defined as EP star divided by P. When you have domestic prices rising, that means domestic goods and services are more expensive relative to foreign prices. If that's the case, then people will avoid consuming or buying domestic goods and try to import the cheaper goods elsewhere. That's going to require export of gold. So as you can see, the import and export of gold cancel out. So in the long run, everything pans out, right? CA maintains itself in the long run. The current account, everyone's current account target is satisfied. Comments, questions? I'll give you a flow chart, so to speak, in a few seconds. Okay, so let's do it here. So suppose we have an increase. Suppose you have an increase in the current account, again, for exogenous reasons, for reasons beyond outside of our model. That's going to lead to an increase in domestic P, domestic prices. So that means there's going to be a subsequent gold import. That's going to decrease Q. Again, Q measures the relative price levels between two countries. If Q is going down, that means domestic goods and services are more expensive, and there's a propensity to import. So you would want to buy foreign goods because it's cheaper. And this will lead to a subsequent export of gold, right? Because you need to buy things, you need to send gold out to the country, convert it to domestic currency, and so forth. And this will decrease current account, right? Because export of gold, you're importing more, right? Import's going to decrease current account. So at the end of the day, any sudden shock to the system will reverse itself because price levels have changed. Yes? All right, but you can actually see this self-sustaining system in the FX market as well, like from a financial perspective. So let me give you a step-by-step example. So whatever I described takes over perhaps several years. It's very slow moving because you have to move gold around. But assuming every central bank plays by the rules of the game, fixing that convertibility of gold for domestic currency, there should be no way to exploit, to make arbitrage profits in the FX market. So let me explain to you why that's the case with an example. So suppose domestic currency is USD and the foreign currency is pound sterling. And let's assume that the Bank of England decides to set convertibility of British pound per ounce of gold equal to 1. And the Federal Reserve decides to set US dollars per ounce of gold equal to 2. So there is an implied gold standard exchange rate equal to, so this is USD per 1 pound, and that's going to be equal to 2. Yes? Agree? Hopefully that's not controversial. Okay. All right, so under the same example here, let's introduce a shock. So suppose in the FX market, the exchange rate suddenly becomes 3, right? So in other words, pound sterling is more expensive. So as finance practitioners and arbitrageurs, you should notice that there indeed should be an opportunity. currency is fungible, gold is fungible. We have a currency, British pounds, that has two different prices, right? One is an implied price based on the convertibility of gold set by each central bank. And we have a market price, for some reason, is set to 3. You can exploit this by buying low and selling high. So let's go ahead and do that. Let's borrow 2 USD and redeem 1 pound at EG, right? We can do this implicitly, right, because there is an implied exchange rate from the gold convertibility ratios. 2, let's sell that pound for $3 at FX market. And lastly, let's return $2 and have 1 USD as riskless profit. Done, right? Hopefully this is obvious. So let me summarize again. This is the mechanism in the financial markets, right? What I described to you earlier with the price VC flow mechanism, that's kind of like an economic explanation of why current account targets should maintain itself through the changes in price ratios. But if there is a perturbation in the FX market in such a way in which price levels are different, this system, this setting cannot exist, right? Because arbitrageurs will come in, speculators will come in and try to make riskless profit. The reason why you can make riskless profits is because we have a fungible asset, British pounds, or if you want to think of it as gold, that's fine. And we have two different prices, right? One low price, one high price. Obvious way to arbitrage is, again, buy low, sell high, right? We borrow 2 and we sell it. We borrow 2, convert it to British pounds through the central banks. We sell that British pound for $3 in the FX market. And we return the 2 USD, and we keep the residual. If this is executed instantaneously, right, it's virtually risk-free, and it requires no investments. So by definition, arbitrage. Can someone tell me why this arbitrage strategy will ultimately lead to the convergence of E and EG? Which step will allow that convergence to happen? So let me say that again. If this setting exists, arbitrageurs will come in and try to make riskless profit, correct? The question I have for you is, well, which step here is the mechanism that will drive E, which is set equal to 3, down to EG? Yes, exactly, the second step. Because you are selling the currency, right? You're selling British pounds that will make British pounds less expensive over time, right? That's the mechanism at play here in the financial markets. You need these speculators to come in to exploit this strategy fully until there is literally nothing left on the table, right? And nothing is left on the table when E is equal to EG. So this is the step. Selling pound will decrease E. That means USD stronger, weaker. Right? Selling something will decrease its price. Selling shares of a stock will decrease its price over time. Same thing with foreign currencies. They are, again, no different. It's just another asset class. So, yeah. OK. Everything crystal clear? Do I need to repeat the steps, or explain further, because this is kind of the cornerstone of this class. I will ask you many, many times to show me an arbitrage strategy, and you basically have to do the following, like outline the steps, explain what needs to be done, what needs to be borrowed, what needs to be invested, what needs to be sold, etc. And explain to me why it's riskless and requires no investments, which are the two key conditions for arbitrage. Yes? Everyone's good? All right. All right, so gold standard. The reason why the gold standard, as I explained before, is not so good is because it's limited by gold supply. Additionally, moving gold around from country to country is very costly and slow. So that can be particularly problematic because you don't know when the inflation or deflation is going to come. So what Keynes suggested is to kind of play an additional game on top of this gold standard. And rather than move around gold, Keynes suggested we just simulate, just pretend that gold is actually being moved by expanding and contracting money supply of a country to simulate inflation and deflation. So, for example, back to the example in which we have an import of gold. When we have more gold coming in, you should get inflation. Yes? So rather than wait for the gold to come, for the inflation to come, right, slowly, Keynes suggests that everyone in the system should just pretend that inflation is already here. And they can do that by expanding money supply, right? By conducting expansionary monetary policy, you create artificially inflation before the gold arrives. Okay? Same thing when you have an export of gold, right? When you have an export of gold, you create deflation. Well, rather than wait for gold to be exported and arrive at the foreign country, what you can do is you can simulate deflation by contracting money supply, right? You can you can sell assets, right? You can sell assets to contract money supply, and in that sense, you can create deflation before actual deflation arrives. So if you play this game according to these new set of rules, there should be no reason to move gold at all. Everyone just do what they're supposed to do, and there's no reason to move gold at all. And we get the same mechanism at play, right? The same mechanism takes place quicker, right? It's expedited without actual moving of gold. So you just need somebody to keep track of the records of gold movements, right? But you can already see that this is problematic, right? People will cheat. And in fact, the people with the most gold will not follow these rules, have less incentive to follow these rules. So take an example of a country with lots of gold already in place. Rather than play the rules of the game, which means creating inflation if there's more gold coming in, they just don't do anything. They don't do anything. That means they welcome the inflation, and they get to keep more of the gold, right? They get to keep the gold that's going to be moved. If you have a current account that's very, very negative, you have every incentive to play this game, right? Because you don't want gold to leave your country. Otherwise, you can't participate in international trade anymore. So that's why it's an asymmetric burden if you play this game, right? The countries that already have lots of gold have every incentive not to play. Like this, they won't create inflation. They'll just let inflation occur naturally on its own. They will let gold be moved from one country to the other. Conversely, if you're a country with very negative current account, you want to prevent further decay in your gold supply, so you will play this game. You will try to deflate your currency, conduct contractionary monetary policy to the point that you have no more assets to sell, right? If you don't have any more assets to sell, then you're in trouble. You can't trade anymore, right? All right, so the takeaway here is that the gold standard is not good because the incentives are perverse, right? They certainly benefit those who are big players, such as the UK at that time, and other other countries that are basically imperialists, and it hurt those emerging economies significantly. So the rules of the game was frequently violated all the time. Right? So let me give you an example here. So this is the United States, presumably under the gold standard. So what happened? They played by the rules of the game up until 1860. So what happened in 1860? Civil War, right? Civil War. So how do you finance war? Well, you become an export-driven economy so that you can get more gold and cash. So you devalue, depeg your currency. So they obviously broke the rules of the game. All right, after the war, they went back on the gold standard, but then you had Great Depression, right? Depegged again. Again, export-driven, tried to accumulate reserves, but anyways, nobody played by the rules, in other words, okay? Sorry, this is this. All right. So what I just described is here, right? Beggar thy neighbor policies. So when they're in trouble, when they're experiencing, idiosyncratic shocks within their country, they will try to externalize their problems. How do they do that? Devalue your currency. It's the same thing what people have been accusing China of intentionally devaluing the currency so that they can support their export-driven economy. And so after World War II, people tried to move onto a different standard. Okay. So what is that standard called? It's called the Bretton Woods system. So the Bretton Woods system is kind of like two layers of pegging. So you have one country, the United States, maintaining a convertibility of gold with their currency, and all other countries peg their currency to the US dollar. Okay? You can already see that while it simplified things a lot because every other country only has to peg to a fiat currency, but it imposed a significant burden on the United States, right? Because they have to not only maintain the currency, but they also have to maintain the gold convertibility, but they also have to absorb all the exports that all other countries want to give away. After the war, obviously all countries like Germany, France, all European countries were disrepair. They wanted to boost their economy. Natural way to boost their economy is to incentivize exports. So they wanted to set their conversion of their currency with the US dollar at a rate that benefits their exports. And somebody has to absorb all their exports. And that's going to be the US. This will lead to, obviously, again, perverse outcomes, right? There's this, what you get is basically a bank run problem, right? If everybody decides to redeem their US dollars for gold, US may not have enough gold to keep their promise. And this is called the confidence problem, right? Much like a bank run. Right. So that's what I just said. All right. So ultimately, abandoned for two reasons, as I just explained. There's the nth country problem, where U.S. has to absorb all the exports, right? That unfairly puts a burden on the U.S. And U.S. obviously has problems balancing its internal balance and external balance, right? They have their hands tied for their external balance, so it's going to be very difficult to kind of conduct monetary policy to maintain their economy or to grow their economy. Secondly, when you have this system, you have that redemption problem that I talked about, right? There's a confidence problem in which if all at once people try to redeem their US dollars for gold, US may not have enough gold to satisfy the redemption. Okay, so in the long run, we went off all backing currency that's backed by any sort of assets. No other currency, in general, for all developed countries, all their currencies are freely floating. So that means it's primarily driven by interest rates. Okay, and I kind of explained that earlier in this class, and you'll see how interest rates play a key role in FX returns next week. Okay, so as a result of no longer relying on backing currencies with commodities, we obviously have frequent financial crises, which you maybe, I think you have experienced this one, right? I don't know. I certainly did. But so let me explain this graph a little bit. So after depegging in the 1970s, the U.S. underwent several oil shocks. So as you know, oil is denominated in U.S. dollars. So whenever the U.S. dollar becomes weak, you have flight to safety. So here we have people moving from dollars to gold. So these peaks are all oil shocks. And then we have some period of stability, but then we have the financial crisis, right? 2007, 2008, where people, again, move from U.S. dollars to safe assets, namely gold. All right, so frequent financial crisis is part of the feature of a floating exchange rate system. Okay. All right, so that's a brief history of international monetary systems. We are going to be primarily focused on analyzing exchange rate determination under a floating exchange rate system. I will talk about Hong Kong as a special case with a fixed exchange rate and its implication on monetary policy and fiscal policy. But that's going to be several weeks later. But I will talk about these other regimes later on, but I want to build a model in mind in which we allow these FX rates to fluctuate with respect to other macro variables. All right, so comments, questions? So I will finish today with a summary slide, which I think a lot of students liked when we were under the Zoom lectures. So let me do this as well to give you the key points of today's lecture. So today, we talked about macroeconomic accounting. The reason why we're talking about macroeconomic accounting is because we want to link foreign exchange rates with the macroeconomy through international trade. International trade is summarized through the current account, which I define in two ways. The first way is through net exports minus imports, and the other way is through savings abroad, right? I proved it to you, the formula. So these are saying the same thing, but in two different perspectives, right? One is movement of physical trade, commodities, goods and services, and so forth. The other is in terms of returns, investment returns. Okay? So the current account, therefore, interpretation of the current account, however, is basically the same thing, right? If you have a positive current account, that means you're essentially a net lender. You're either lending in terms of real goods and services that you expect to redeem by buying goods and services from your trading partner in the future, or it means that you are expecting returns on your investment from your investments abroad, right? That's what a positive current account means. A negative current account means the opposite. It means you are a net borrower. You are consuming today with the promise of delivering exports sometime in the future. In the financial sense, pretty much the same thing. You are accepting investments today, but you have to deliver investment returns sometime in the future. So that's, this is the summary, what I just said. Okay. And, the final definition or interpretation of the current account is more of a dynamic interpretation of the current account with respect to changes in macro variables, right? So I told you that the current account can be thought of as trade volume component plus a relative value goods and services component. The reason why we're looking at this is because we want to understand how this variable evolves over time when there's a macro shock to prices, shock to exchange rates, and so forth. And basically, to summarize, trade volume is driven by the incentive to export, to substitute it away from more expensive goods, right, towards cheaper goods. And this relative value goods and services is driven by assets being more valuable in a certain country Okay, so it has competing effects. So depending on how long of a time horizon you're looking at, one effect may dominate over the other. All right, so current account surplus deficit, is it bad or good? Well, it depends on the country. It depends on the objective of the central banks and the government. But in general, you don't want to have excessive amounts of either type, right? You don't want excessive positive current account. That means that you're foregoing investments domestically, and you're neglecting growing your own economy, and your returns may not be good, right? Because you may have excessive, you may be actually lending to countries that have excessive risk, like Africa, that may not ever pay out in the future. You don't want to have a significantly negative current account either, because no one's going to otherwise believe that you'll grow enough to return their investments, right? So you want to be somewhere around zero ideally. But I'm making the case that you don't want to be at either extreme. Gold standard. All gold countries under the gold standard sets a convertibility for some quantity of gold with some quantity of their domestic currency. That conversion ratio is fixed for every country under the gold standard. Those are the rules. Under those conditions, there is natural price stability in the FX markets, because there is an implied exchange rate for any combination of currencies as a result. So the central bank's only responsibility under the gold standard is just to maintain infinite convertibility of gold / domestic currency for the other. Under the gold standard, importing gold will cause inflation. Exporting gold will cause deflation. These are the primary mechanisms that describe the price specie mechanism. Yes, and I can go over the verbal proof again. So suppose everyone sets their gold conversion ratios and pegs it indefinitely, and suppose everyone's current account levels are satisfied. Suppose there is a sudden perturbation of the current account away from the ideal scenario. Then what's going to happen in this case, in which the current account exceeds the target current account, is there's going to be gold being imported, right? Higher current account means somebody wants to buy your goods and services. They're going to bring their gold over. That's going to raise prices. Raising prices, however, is going to disincentivize people buying goods from you, and your country is going to try to import goods from elsewhere, right? That's going to require an export of gold. And as a result of exporting gold and importing goods and services, the current account is going to be restored eventually, right? CA equals CA star. So you can obviously describe the reverse when it's the opposite direction, right? Suppose CA is less than CA star, everything is reversed. So Keynes tried to kind of expedite these gold flows by kind of saying, well, if everybody played by his new rules, in which everyone simulated inflation, then we wouldn't have to move gold around. And perhaps there's more people who can participate in this game. Right? You can have negative quantities of gold, maybe, which is fine. But nobody followed these rules, all right? And it's just perverse incentives. Those with very, very high current accounts will have every incentive not to play, try to hoard gold, and in fact, just welcome inflation. Those, on the other hand, with very, very negative current accounts don't want gold to leave, right? So they'll try to play, but in order to maintain deflation, they have to sell assets. If they run out of assets to sell, then they can't participate in international trade anymore. All right, so this concludes my summary of today's slides. So